during our Money Matters event. This evening, we will be focusing on borrowing. Our partner from OneAZ Credit Union, Vanessa, will actually be the expert who will present on this important topic. Now, we know that we do have some participants, waiting in the waiting room. So while we wait, we want to take a moment to go over some housekeeping items to ensure that our event goes as smoothly as possible and that all of our participants feel welcome and comfortable. Well, first, we would like you to take a moment to check how your name appears on the participant list. If you need to update your name, please feel free to do so now. We ask that your first name, last name, as well as your pronouns are displayed. This will allow us to properly address you and get to know you better. Also, if you are a participant here for extra credit, by having your name displayed, we can make note that you are here today. If you're not quite sure how to update your name, there's a few ways to do so. One way is to look down to the Zoom toolbar. You should be able to see a tab that says Participants. Click on that tab and a window will open showing you everyone who is part of tonight's event. Your name should be at the top of that list. And when you hover your mouse over it, you should see 3 dots. Click on those 3 dots and it will give you the option to rename your Zoom profile. Another way to update your name is by looking at the webcam tile that should be across the top of your screen. Your name should be the very first tile that you see, whether or not you have your camera on. When you hover your mouse on the top right corner of your Zoom tile, you should see the option to rename your Zoom profile name. If for some reason you cannot update your name, no worries, you can directly message Anna Brown so she can update your name for you. And again, we kindly ask that your first name, last name, as well as your pronouns are displayed. Please be aware that tonight's presentation is being recorded for educational and promotional purposes. This recording will be available on the FYE's YouTube page in case you need to reference back on what you have learned, or if you would like to share with someone who wasn't able to make it to this live event and will benefit from this great information. If you do not wish to be part of tonight's recording, you are welcome to leave your camera off, and there will be many opportunities for you to engage during tonight's event. If you prefer to leave your camera on, we encourage you to do so because it allows us to see your friendly faces. We do want to inform you that captions are available for tonight's event. You have access to those captions by looking down at your Zoom toolbar. Click on the 3 dots that say More, and then it will give you the option to show subtitles. By the way, our recording will also have closed captioning for everyone. Now, in order to make sure that we can easily hear and understand our speakers, we ask you to please make sure that all microphones are muted. If you do have any questions throughout tonight's presentation, please feel free to type in your questions on the chat and we will make sure to address them. Please note that we will also have allocated time for questions and answers at the end of the presentation. Last but not least, we want this to be a fun and safe experience for everyone. So thank you for making sure that all conversations stay respectful, civil, and clean. Please be aware that at the end of tonight's presentation, we will share a feedback survey via chat so that you can provide your feedback. In addition to your feedback, which is very important to us, it also allows us to give you the proper attendance credit for staying with us for the entire event. Anyone that completes the survey will be emailed a certificate of completion and will also get entered in our $300 tuition award drawing. All right, so let's talk a little bit more about those prize opportunities. If you follow us on social media, you will be entered in a drawing to win some cool Pima swag. So make sure that you follow First Year Experience page on Instagram, Facebook, and Twitter. You can find their page by searching at Pima FYE. You can also find the Office of Financial Aid and Scholarship page on Instagram by searching at pima.financialaid.scholarships. These handles are displayed on the screen and are also being shared on the chat in case you need them. We will announce 2 winners at the end of our event for the prize opportunity, so please make sure to follow us. Another prize opportunity is provided by our partners from OneAZ Credit Union. Visit the partnership webpage between Pima Community College and OneAZ for a chance to win a $75 Visa card. More details will be shared later in tonight's event. And again, please make sure to complete that feedback survey so that your attendance is captured. Anyone that attends both Money Matters events this semester, stays for the duration of the event, and completes both of the feedback surveys will be entered into a drawing to win the $300 tuition award, which can be applied for the spring 2024 or summer 2024 semester at Pima Community College. Well, it definitely takes a village to bring our presentation to you tonight. So we would like to take a moment to introduce who we are. Joining us in spirit is Renee Forsythe. She is the program coordinator for first year experience at Pima Community College. Although Renee was not able to virtually join us this evening, I want to recognize her contributions as she is very important in our team. Another great member that was not able to attend tonight's event, but plays a crucial part in what we do is Carla Gonzalez. Carla is the Assistant Director of Scholarships and Outreach at Pima Community College. And to those that I have not met, my name is Simara. My pronouns are she, her, and hers. And I am the Outreach Database Operations Coordinator for the Office of Financial Aid and Scholarships. And it is a pleasure to be here with you today. I will now let my amazing team introduce themselves.
Hi everyone, my name is Anna Brown. I'm excited to be here. I am the coordinator of scholarship operations at Pima Community College. I'm excited to learn along with you all.
Hi everyone, my name is Juanita Bonias and my pronouns are she, her, and hers. I'm the program manager for the Second Chance Pell Grant program. I'm also excited to be here with you tonight. Thanks for joining us.
Next, we have our wonderful partner from OneAZ Credit Union, Vanessa.
Hi, good. She, her, and hers. I am our Southern Region Sales Leader with OneAZ Credit Union.
Thank you. Well, now, as promised, please welcome our speaker, Vanessa, who will be presenting on the basics of borrowing. Let me just stop sharing.
Yes, I am excited to cover this topic. This seems to be something that we can all benefit from, whether you are just starting out, you're mature, you're young. We're going to cover a lot of really great information on the basics of borrowing. So I'll go ahead and just jump right in. I know the chat's going to be going off with lots of questions, and I'll get to those towards the middle and the end of our presentation, but we'll go ahead and get started. Okay, let me go ahead and move my toolbar here. Okay, so today we're going to learn about the basics of credit, loan types. That could be credit cards, personal loans, auto loans, mortgage loans. We're going to get into some different facts and some information on each one of those types of borrowing products. We also have tips for paying off debt and borrowing wisely, and then we'll get to some questions and answers towards the end of the presentation. Okay, so today what we want to walk away learning, what we should learn is we want to know how to build credit and maintain or improve your credit score, understand how credit cards and personal auto and mortgage loans work, and hopefully we'll know your options for paying off debt and understand good borrowing practices by the end of this presentation. Okay, so basics of credit. we have unsecured versus secured debt. This is some of that lingo that you might hear at your financial institution, maybe that you've seen. Maybe you're looking at different type of lending products and you really aren't sure what the differences are. We'll get into some of that. But some lingo that you might be hearing are the revolving credit versus installment loan, amortization. And we'll go into what the differences are between these types of accounts and how your loans accrue interest and how quickly you can pay them down. Okay, so if you have a fixed installment loan, you might hear front end loaded. What that means is if you have an installment loan, like an auto loan where it's not revolving, the majority of your payment up front is going towards that interest. So we have a little chart here that shows you once you make your first couple of payments, even for the first year or so, a good portion of that minimum payment is all going, or most of it's going towards your interest and very little going towards your principal. That's typically what you would see on an installment loan, which is a fixed loan. Fixed loans are a set term you agree to. And once that term is finished, that loan is completely paid off and you would have to reapply versus a revolving loan where, similar to a credit card, you pay it down and you can use it again. So installment loans are typically front end loaded. You might hear that term. Towards your middle of your loan, you're starting to pay more towards your principal, helping you pay down that balance quicker. And towards the end of the loan, if any of you have ever paid a loan off or gotten toward the end of an auto loan or any other type of installment loan, you might see that the last couple of payments, you're really paying down towards that principal and very little is going towards your interest on an installment loan. So some credit lingo, high versus low interest, high interest rates. We know that we're hearing that a lot lately. These rates are a lot higher. My interest rate is high. I'm looking for low rates. So we're going to go into how you can get the best rate, even when rates start to climb and maybe are a little higher than what we've seen in the last couple of years. So the best way to shop for the best interest rate and to get the lowest interest rate is really going to be to pay attention to your credit. Understand your credit score. This is really where you start for anything lending, all your borrowing needs. It's important to understand how your credit works. Most of you probably have established a credit score. Maybe we're in a place where we maybe need to repair. We don't really know how to do that. But if you can, we aren't always in this position, but if you can, take a look at your credit score, understand it, and let's do some work on it before we apply for any new loans so that you can guarantee that you're getting the lowest rates possible. So if you're in a position right now where maybe you don't understand credit, maybe you haven't built any yet, or maybe you're looking to repair, here's some good information to know. What impacts your credit score? There's no magical calculation that I can give you, but what I can tell you is what impacts it the most. And that's going to start with your payment history. 35% of your credit score is made up of your payment history. So it's crucial that you make those payments on time. Borrowing and paying it back. This helps lenders read your story, understand your story, and know that you've been responsible with your payment and sticking to those terms and agreements that you originally signed for and accepted. That's 35% of your score. So if you're late one time, your score can drop significantly by just being late on one payment. Now, over time, that late pay will have less of an impact on your credit score, but still it's a pretty good impact to your score. So if you're paying those payments on time, you should be in good shape with your credit score. The second biggest factor that plays into your credit score is going to be how much you owe. So this is going to be important to understand once we get into the credit card portion. So you have revolving accounts. We all have, hopefully have credit cards, or maybe we're using them responsibly, but 30% utilization is what we're looking for as lenders, and that's going to help significantly increase your credit score. So if you have a $10,000 credit card limit today, you'd want to make sure that you stayed under $3,000 owed if you had to use that credit card in order to maintain a good credit score. So 30% utilization is the rule on amounts owed on all of those revolving accounts. So what you'd want to do if you're looking to repair your credit or improve your credit score is add up all of those available limits that you have and see what it would take to get you down to 30% utilization, what you can pay off in order to get you there. And you'll see a significant increase in that score. Length of credit history. So we do get a lot of questions around this one. We've been asked, should I close out my credit card once I pay it off? And really, that answer is not the same for everyone. But what I will say, 15% of your score is based off the length of time you've had those accounts open. So let's say you got your starter card when you were 18, 19 years old. Maybe it has a low limit, but you've had it for 10 plus years. You'd want to keep that card open because it could significantly drop your score if you closed an account that you've had established for quite a while that was in good standing. So every scenario on that one is a little different. You may have a mortgage lender recommend that you close a credit card even though you've had it for 20 years, but that might be to help improve your debt to income in order to qualify for a home. And we'll get into that a little more later, but definitely looking at 15% of your credit score, reviewing that history and trying to, if you can, keep those good standing accounts open so that you have a good story to tell, a consistent story to tell, and it shows that you paid on time for several years on one account that you've been responsible. 10% of your credit score is going to be your credit mix. So you do want to show a lender that you can be responsible with unsecured debt, revolving debt, and also those installment loans, that you can stick to that agreement that you originally signed up for. It's good to have a revolving line and an installment because it also shows that you can responsibly use a credit line. So it is a good idea to have a mix. So if right now you only have a credit card, you want to look at maybe your installment options to help boost that credit score, or vice versa. If you only have an auto loan, you might want to add a credit card, even if you're not planning to use it consistently, just so that you have that good mix and you can show that responsible pattern in history. And new credit. So be careful with this one. This can increase or decrease your score. 10% of your credit score is made up of your new credit. Typically, where we see this become a negative impact on your credit score is when you acquire too much debt within a short period of time. So keep those inquiries and those new accounts to a minimum. Typically, you'd want to only open 2 new accounts every 24 months. That might not seem like a lot, but if you really think about it, we really shouldn't have a credit need that great or more than twice every 2 years, unless we're opening up multiple credit cards. Typically, you're not going to buy 4 vehicles within that 2-year time span, but keeping that at a minimum within the 24 months, we're looking for those two inquiries is great. If you have a few more, that's fine. And one thing I do want to clarify here on the inquiry and new credit is if you are shopping rates, that does not impact your score as long as it's within the same 2 weeks. So lenders want you to shop and get the best rate. You absolutely should. So if you go to a dealership and you go to buy a vehicle, you might see 10 inquiries because they're shopping multiple banks for you. That will not count towards multiple inquiries on your credit score as long as it's within a 2-week time frame. So that right there in a nutshell is what really makes up your score. I wish I could give you the exact calculation, but if you pull up your credit report today or sometime soon and just kind of analyze where you're at, maybe looking at some of these little tips might help you increase your score by just getting down your utilization and looking at maybe your length of time and your credit mix. Those are some easy, quick fixes to improving your credit and just building a score in general. Okay, some basics of credit. So when we talk about credit cards, we're not using our own money, we're using the bank's money. And when there's risk involved with the bank, we're going to get those higher rates. So if you're using a credit card, it is not like a checking account. We've had members, make this mistake. When you're using that credit card and you're at your favorite store, the bank is actually going to pay them for you. And you're going to pay us back plus interest. So we're going to get into paying those credit lines back responsibly. So you're basically borrowing our money in order to make that purchase. So it's extremely important that you don't misuse those credit cards. There are a lot of myths and misconceptions around credit. We hear credit cards are bad. Not necessarily. We need them sometimes, but we want to use them responsibly. So if we're looking at maybe going to a concert, that might be something you'd want to save for. So if you took our last budgeting and savings presentation or you attended, you would know that there are ways to use that card responsibly. And sometimes we have to pay for those emergencies, like those auto repairs, medical bills. But we want to make sure we don't carry a balance if possible, but we may need to use them. But it is okay and can be safe to have a credit card when we're responsible. So applying for a credit card hurts your score. That is or can be a misconception. So if you don't have multiple inquiries and you're in the process of building up your credit, or this is your first new account you've had in 4 years, it's not going to have a negative impact on your credit score. As long as your utilization is down and you're not overextended on credit. Carrying a balance builds credit. We would like you to pay that off. It's the usage though. You do want to make sure you're actively using those credit cards and that you have a payment to report on a regular basis. Sometimes we see somebody get a credit card, they're scared to use it, and then they don't. And now there's no payment history to report to the credit bureaus, no story to tell. And so we aren't really sure if you can pay those payments on time if you were to have used that credit card. So it's okay to use it. Some people like to use it for their gas purchase and then they pay it off every month. That's a good practice in helping the lenders see that you can be responsible with using it. Another reason why you'd want to use it, but maybe not carry a balance, is because it can go dormant and they can't always close that card on you. So if you do have a long-standing credit card that you've had for 15 years and you don't want to use it because you feel like it might hurt your credit by just making those purchases, they can close that out on you and that can significantly drop your score. So that's another myth and misconception. And then again, we talked about this a couple different times. Canceling your unused credit cards helps your credit, and it can actually have the reverse adverse effect on that and actually drop your score. So just be careful. Do your research. If you have a personal banker, work with them. If they have access to your credit report and you have questions, definitely ask them for some guidance and what would be best if you are looking for a credit card or even just reviewing your credit report and next steps. So safely getting a credit card. So we know you're borrowing our money, the bank's money, the credit union's money. So you're going to look at your rates. We want you again to shop. This is a reason why you'd want your credit score to have been increased, because you're typically going to get a lower rate on a credit card. So do your research, shop the cards that are best for you. Consider your fees. There are some credit cards that offer lower rates, but then you might be paying $125 annual fee. So really do your research, look up 5 different credit cards if you have to, and do your comparison. Looking at your credit limits. If you're going to get a credit card because you know you need to make a purchase for a certain dollar amount, look to see if that's going to be enough for that 30% utilization. So if you have a $2,000 purchase that you know you need a credit card for, you're going to want to make sure that if you did use $2,000, you were under 30% utilization for that credit limit that you're approved for, if that limit's going to be enough to help maintain that good score, or even enough for you to qualify to make that purchase. On the other side of that, we also want to make sure that we're not overextending ourselves on debt. So if you're not comfortable with a credit card with a $10,000 limit and you want to keep it lower, that's also something to consider. Sometimes when we have that limit available, we get ourselves in trouble, but you know yourselves best. So just consider all of those when you're shopping for those credit cards. So timeline. So we saw earlier in the slide that you went to your merchant, or maybe you had a $1,000 auto repair. You have a credit card that did not have a balance on it, but let's say on the 10th of the month, you had an auto purchase for $1,000 or an auto repair for $1,000. You needed to use that credit card. Because you started off with a zero balance in that billing cycle, your first bill is going to come out on January 31st. Now, maybe that 21-day time frame wasn't enough to pay off that $1,000 right away, and that's okay, but you're going to get a statement at the end of that billing cycle that shows that you have an outstanding balance of $1,000. So come February, you owe $1,000 or your balance is $1,000, but maybe your minimum payment is maybe $30, $25. I'm not sure. I can't quote a payment without knowing the rate, but let's just say you still have a balance of $1,000. Now on February 7th, the mechanic said, we didn't fix the problem completely. We need another $500. You had to bring your car back. Now you're carrying a balance of $1,500 on that credit card. You're still within that billing cycle. When they sent you your statement on January 31st, your payment wasn't due until February 26th. So that gave you some time to pay that down. Now your payment date was February 26th. That is your due date. Your balance due on this one was $1,000, and you went ahead and you paid way more than the minimum payment. Maybe you had some savings set aside, or you had a better paycheck that pay cycle, whatever that might be. You were able to pay $1,000 towards that credit card balance. So way more than the minimum. So at the end of that billing cycle, it left you with a $500 outstanding balance. Now, one thing I want to call out here is that payment was due on the 26th, but your billing cycle ended on the 28th. Now, you would want to check with your credit cards. So on the 26th, it's due, but it's actually not going to report to the credit bureaus for a couple more days. So let's say you made your minimum payment on time on the 26th, but then you got paid on the 27th and you wanted to apply more towards that billing cycle. That would have updated as well by the 28th. So what would have reported again was the $500 outstanding at the end of that billing cycle. So you still have a couple of days in between your due date and the end of the month before it actually reports to those credit bureaus. I'm sure most of you have seen that. If you maybe made a payment on the 5th and you're sitting there wondering why it hasn't updated and it's already the 9th, it's because your billing cycle ends a few days after. Now, I will say pay the payment on the due date. Don't trust the billing, run towards the billing cycle, because you will still get late fees. And some of those lenders charge 1% of your outstanding balance as a late fee. So even though your billing cycle might end on the 28th, if you don't pay it on the 26th on the due date, you might end up paying 1% of the balance plus additional fees if you don't pay on time. So be careful with that. But you do have a couple days in between to apply more if you want to get it in on time before your billing cycle ends. Okay, so March 1st, our new statement showed that we owed $500, and March 24th, our bill was due, and we went ahead and we paid that off completely. So smart borrowing there. We paid it off as soon as we could. Now, when that billing cycle reported, we showed a zero balance outstanding, which is what we want to see, but we're also going to see that there was payment activity. So that does help your score. You ended at a zero balance, but we also know that you made a payment that month, and that reported to the credit bureaus. So this person made a payment and it showed that they made payments on time and that they were in good standing. That is how the credit card cycle works. Okay. So we have the grace period. Again, be careful with this, read the fine print. Every credit card is different. You might have a grace period where they don't charge you a fee, but in most cases on a credit card, you will get it the day after you're late on that due date. So be very careful, read that fine print. Okay. And we're going to talk about minimum payment versus your balance due. So in that previous example, that person paid more than the minimum. But typically 2% of your balance is your minimum payment with the lender. But again, you'd want to read your fine print. Some are interest only. But in this case right here, if you had a $1,500 balance, your payment might be $30 minimum. We're not going to get very far with that. So if you only paid the minimum, if you owed $5,000, and your interest rate was about 19.99%. And I will tell you that's low right now. These interest rates are not exact. They are estimated. This is about what interest rates are. Some are higher. Some of the larger banks are charging 28% interest right now on credit cards. So be very careful. But in this scenario, a $5,000 purchase, 19.99% interest on your credit card, you paid the minimum payment of $100. If you just did the minimum payment of $100, it would take you 8 years and 4 months to pay off that $5,000 purchase. And you'd be paying almost double in interest. So you'd be paying $4,985 in interest on a $5,000 purchase. So you're basically paying for that twice. So do you want to pay for Hawaii twice? Was that a need or a want? So be very careful when you're swiping that card. It is easy to get to $5,000 when you're at your favorite stores. Maybe you went shopping, the holidays are coming up. So really assess if that's a need or a want, and go back to that budgeting and savings mindset that we had in our last presentation, because this could be very costly and cost you a lot of money. Now, some of us might have a $5,000 medical expense. That might be something out of our control. That might be a need. We might have to pay that. But if this is a Hawaii trip and you can only afford the minimum payment, you're going to be paying a lot of interest to have that good time. Okay, now we'll talk about personal loans and the difference between why you might want a personal loan versus a credit card. So personal loans can be used for anything. You can actually have cash in hand. So some people need the money right away. On a credit card, there are cash advance fees. So again, read that fine print. So if you want to avoid even higher interest and fees to take cash off your credit card and you need cash right away, you might want to look at doing a personal loan with your lender, because you can walk away with that cash in hand for the same interest rate that you agreed to in the terms. They're not going to up that on you. It can be used for anything. So we see a lot of people like this for home repairs because typically they'll get a deal on with their repairman if they pay in cash. Unexpected large expenses. So you want a fixed payment and you want to know that it's going to be done. So if you want to pay this off within a certain period of time and you have a medical expense, unlike a credit card, if you did a personal loan, you can come to the bank and get a term set to where you want to pay it off in 24 months. And you know when you make your last payment that loan and that debt is done. Unlike the credit card where it's revolving and you get stuck with those minimum payments and you may not be making as much of an improvement on paying that debt off as you anticipated or you wanted to. So some people prefer a loan because they want to know that it's going to be paid off in a set period of time. Maybe like we have here, the medical expenses, car repairs, maybe you needed a new AC. We see a lot of people come in for different reasons on a personal loan. And we know also that's going to be a one-time expense. On a credit card, that is a revolving limit. So you can pay it down, you can use it again. Some people prefer to use a credit card for all of their utility bills, their monthly expenses, because they love those rewards points, but they pay it off every single month. Let's say here, you know, you only have that one-time expense, your water heater goes out, maybe you're, graduating, you have that one-time fixed expense that you need to pay for. A personal loan would be a good option for you in that case. Okay, personal loans. We also have personal lines, so that can get a little confusing. So if you have a personal line, you can actually use that again. You might say, why would I want a line of credit on a personal loan versus a credit card if I can just have it revolving? But some people prefer that because they can link it to their checking accounts for overdraft protection. Maybe they need to pull cash out or they need to transfer funds from a line of credit within their online banking app. Maybe your bank's closed on the weekend, you have an emergency. Some people like the flexibility of having a line of credit available to be able to transfer from right away if they need it. But again, that personal loan is also that installment loan. It's fixed, and once it's paid off, it's done. Okay, so let's talk about some loans that we might want to stay away from now that we're talking about unsecured. So personal loans, lines of credit, those are unsecured, as well as a credit card. So when I talk about unsecured, it means there's no collateral. Now, one thing to know is if there's no collateral tied to a loan, that means there's greater risk for the financial institution or the lender. If you fail to pay, we have no recourse. You're going to see higher rates on all your unsecured products, loans, lines, and credit cards. But where you really see some high rates is what we call predatory lending. You will not see this at your bank, hopefully, or your credit union. This is something to be aware of. So if you are in the need of a personal loan and you see those payday loan advertisements, actually, I think those are even illegal in Arizona now, title loans, short-term loans, these interest rates can be as high as 204%. This is considered predatory lending. Be very, very careful and very, very cautious. These are not loans that you want to get involved with. And if you do have them today, figure out what options you have. Sometimes you can actually pay these title loans off with an unsecured loan with your lender, with your bank or your credit union. So if you do have any of these and you are paying these high interest rates, seek help with your current financial institution and see if you have other options available to you. These can be very tricky. And if we are still offering payday loans, you get into this vicious cycle of needing one every 2 weeks just to keep up with those large payments and high interest owed in those short-term lending options. Okay, auto loans. These are considered secured. So we have collateral. Your auto is your collateral. So if something happens, life happens, and you fail to pay, the bank still has recourse. We still have that collateral. We still have a lien placed on that vehicle. So if we needed to, we can always regain possession of that vehicle and try to resell or recoup some of our loss there. So unlike unsecured, auto loans are considered secured debt, which is why you see much lower rates on an auto loan than you would see on a credit card or a revolving line or loan. So what we need to know, we saw earlier the example of the front end loaded loans, and that'll typically what you're going to see on an auto is that the majority of your payment up front is going to go towards interest. Principal is the principal balance of your loan is going to be the amount owed. So that's what you want to pay down. The cost of the vehicle. So if your principal was $27,000, then you have your interest rate, which is different, which could be around 6% right now on a new vehicle. Your principal is going to be the actual cost of the collateral. And your interest is going to be what the bank charges in order for you to use our money to make that purchase. Okay, some things to consider on an auto loan. So you're paying that daily interest. So pay on time, you're going to pay the exact interest schedule for that agreement. Some of you may have looked through some of those terms and conditions when you recently purchased an auto or you purchased an auto in the past. You might have seen something called an amortization schedule. In order for that to be exact, you're going to want to make those payments on time and as agreed. That means you're going to pay no more or no less than what you originally agreed to on those terms and conditions of that loan. If you pay more towards your principal, even if it's $10 more a payment, you're actually paying less interest over time than those original agreements because you're paying less on a smaller daily balance. So you're paying down that principal ahead of time, ahead of schedule, and you're paying less daily interest because that balance is lower than anticipated in your original agreement. Now, if you pay late, you're obviously paying more in interest over the life of the loan because you're paying on a balance that wasn't anticipated. We expected you to pay on time, and now you're ahead of paying, you're behind on paying down that principal. So you're paying more on that higher balance, more interest, and you're also paying on those late fees. So that can cost you more money over time. So when you can, even if it's $10, $5, try to pay more towards your principal when you're making those installment loan payments towards your auto. Okay, so an example here, and again, these are not exact interest rates. These are just examples. I don't want to get myself in trouble here. You guys come knocking on my door asking me for a 4% auto loan rate. Those have gone up, but here's just an example. So let's say you have a loan amount, you purchased a vehicle and the loan was for $18,440 and your rate was 4.79%. And you signed up for a 48-month term. Your minimum monthly payment was $422.91. And you paid $25 extra a month. So you just paid that additional $25 towards principal. Your first monthly payment we saw earlier $372 is going to go towards principal and $50 is going to go towards interest. And on your last final monthly payment, $445 is going towards your principal and only $1.90 is going towards your interest. You save almost $800 paying that additional $25 a month, and you're set to pay off that loan 5 months earlier. So just by paying an extra $25 a month towards principal, you're saving yourself almost $1,000, $800, and you're getting rid of that loan 5 months earlier than you anticipated. So if you can pay a little extra towards your principal on those auto loans, that's smart lending, smart borrowing. Some things to consider when you go to buy a vehicle. You don't always need a down payment. Ask the lender, work with the lender on their terms. Dealerships might talk you into doing a down payment, but really know your product. So just like credit cards, do your research. Don't just stick to one bank. You can ask questions. You can go into your own financial institution. They should have a banker there that can answer questions if you want to get pre-qualified for an auto. That also takes out the going back and forth with the dealer, but know your options, know your terms. You may not need a down payment, but as we saw a few seconds ago, the less you owe, the less interest you pay. So if you can put a down payment towards that auto, you're going to be paying less over time because you're paying on a smaller balance, less interest owed over the life of the loan. So if you can put a down payment to save some money, but if you don't have a down payment available, ask questions because one's not always required. Things to also consider would be your gap and vehicle service contracts. This is also to save you money in the long run. We actually just had a member, and I hope this doesn't happen to anybody because it's scary and it's stressful. They totaled their new vehicle. They didn't have gap. So now they need to finance a new vehicle, take on that payment in addition to the one that they already are making, because the insurance company is going to do an evaluation of your car and it's not always what you owe. We know we're looking at inflation right now and vehicles are very expensive. And the minute you drive it off that lot, they're depreciating. So you are stuck now with 2 car payments. I also had somebody call in earlier saying, I'm still working on paying off my loan with you guys. They had medical issues. Yeah, and it can be very expensive to try to afford 2 car payments, and you might not even qualify at that point, depending on what your debt to income is. So gap is important because what will happen is if the insurance company sends you a check and it's less than the amount you owe, the bank will go ahead, that gap protection will go ahead and take care of any other balance that's left over and outstanding so that it'll relieve you from any debt owed for that total vehicle. So look into your gap options. Especially if you're buying new. If you're buying used and you're putting a down payment, you may not need gap, but ask your lender those questions. Ask your personal banker if that's the right fit for you, but know your protection products. And also vehicle service contract. Cars are expensive to fix these days. Technology is great, but one little thing, one button in your car breaks and it can cost you $2,000 to fix. It's insane. My daughter just cost me about $2,000 in car repairs. Her car's only a 2019 and we didn't have a warranty. So lesson learned here, ouch. You know, we took care of it, but I wish we would have looked into extending the service contract or knowing if we had one. Look at what miles the original warranty is good for, because sometimes they'll have a factory warranty, but again, ask your questions here. These are things to consider to save you money in the long run. If you have a vehicle service contract, a warranty, you may not have to pull out a credit card and use $2,500 and pay 24% interest. So definitely if you're buying used or if you're extending the term of your existing loan, I would say a warranty is a good thing to start looking into or asking questions about. Sometimes on new, it doesn't make sense because they come with their own warranty, but definitely look into that and consider that when you're shopping for a new auto. Also, new versus used. New right now, we know, again, inflation. Look really, do you need that new vehicle? Or could we look at used? Used is going to save you some money because obviously the cost is going to be a lot lower than buying a brand new vehicle. And it might even hold its value better. So really look at that. Depreciation, do the research on your vehicles. There's also certain vehicles out there that hold their value better. So just do your research before you jump into a 5-year contract. I mean, that's a big commitment, especially right now. Trying to find a vehicle that's decently priced is very hard to do. Inventory seems like it's still a little low, but do your research. I'm not a Honda advocate. I don't own one, but I know that those hold their value really well. There are certain manufacturers that really do hold their value well, which would be worth the expense. So just do your research. Okay, now we're going to get into all things mortgage. I'm sure we'll have a lot of questions in the end around this, and I will do my best to get through all of this quickly for the purpose of time, but we'll also be very thorough to make sure we hit all these important points. Mortgage lingo. Fixed rate, ARM, escrow. No, your mortgage does not have limbs. That is not what an ARM means. I'll go into that. That can be a little confusing. But if you are looking to buy a home, you're thinking about it, or you're just thinking, gosh, it just doesn't seem obtainable. I don't even know where to start. I don't think I'll be ready to qualify for a home in the near future. Let's go over some lingo, and you might be surprised, or I might be able to answer some more questions for you in the end. But a fixed rate. So fixed rate, most commonly we hear a 30-year fixed. That means you and the lender agree to have your mortgage paid off within 30 years. Your payment is the same, doesn't change. Your rate stays the same, it doesn't change. Peace of mind right now, right? We don't want our rate to increase halfway through our mortgage and us not be able to afford it. So most borrowers lean towards the fixed rate because they like that security and they like that peace of mind. And they also like the affordable term of a 30-year. It makes that payment more affordable. Some people can afford a 15-year fixed. The reason why you might do a 15-year fixed, other than the fact that you'll pay it off 15 years sooner, is also because the rate can be a little bit lower than a 30-year fixed. But on average, we're seeing the majority of the borrowers when it comes to home lending do a 30-year fixed. Now, when we talk about an ARM, that's your adjustable rate mortgage. Talk to your lender. I cannot give you advice on which way to go because it really depends on your financial picture today. But there are different options. So what is an ARM? So that means that you and the lender agree for a portion of that loan, you're going to get a much lower rate. And I'm not quoting any specific rates. This is just throwing it out there. So let's say today on the 30-year fixed, your rate is 6.95%. But your lender says it'll be more affordable and wise for you to consider an ARM because you can do a 5-year ARM at 6.25%. And again, those are not exact rates, but that's kind of what that scenario would sound or look like. Your payment's going to be lower. So that 6.25% is going to be what you pay in interest for the first 5 years. So if you hear 5-year ARM, first 5 years, you're paying that rate. Now, after the 5 years, your rate can go up or it can go down. They're going to reevaluate that loan. So be very careful with an ARM. Do your research. There's also 10-year ARMs. If you do a 10-year ARM right now, it might make sense because your rate's going to be lower than a 30-year fixed. And then you also have 10 years to pay down your principal before you either have to refinance or your loan is reworked. So if you hear 5-year, 10-year, 7-year, that means that you're getting that intro rate for that period of time. Now you have to be careful with this. I don't know how many of you were around to experience the 2008, I was, but what we saw a lot of was people got into these ARMs, and then when the payment came due, their value wasn't there and they weren't able to refinance and the rates had gone up. Now they couldn't afford their mortgage payment. I would say do your research. They're not bad loans, but that is the difference. You have your fixed rate, that peace of mind, that security, that payment's never going to change on you. And then you also have your adjustable rate mortgage, which might work for somebody if you know you're going to be in the home a while, or if you're doing a 10-year ARM and you know you have time to pay down that principal, and that works for you. So I'm not saying either option is better or the one that I would go with, but you really have to know and understand your own financial situation. You could be putting a large payment down and you plan on paying your mortgage off within 10 years. look at your options, but that is an ARM. It's an adjustable rate mortgage. That rate can adjust on you within a certain time frame. Now, escrows. You might hear mortgage insurance, private mortgage insurance. If you're already a homeowner, you might be familiar with this. But escrow is when you agree. Well, there's two types of escrows. So when you go to buy a home, you might go into escrow. You might hear that terminology. That means you're under contract, you're in the process, you're going into escrow. Escrows are also what can go into your mortgage payment. So your lender might say, okay, do you want to put your taxes and your homeowner's insurance within your mortgage payment? We'll build that in when we do the terms and conditions of your loan. Most borrowers have an escrow account within their payment. So the lender takes care of paying that homeowner's insurance and their property taxes. They're responsible for that, but it's built into your mortgage payment. That's how most borrowers have that. That's your escrows within your mortgage payment. But there's also that lingo escrow, which means you're now under contract. Okay, buying a home financial process. If this were only this easy, right? Just have a little chart and fly right through it. But we're going to get into some of these details. Review your credit report. So look at your credit. There's not really a magic credit score for qualifying for a home. So I am going to pause on each one of these steps because there's more information to go behind it I really think is helpful. Know your credit score, have your resources, review your credit. And then it says get pre-approved. Okay, well, what if we're not there yet? So review that credit report with your lender. I know it might seem scary. Maybe some of us don't want to look at that today and we're like, oh, this just seems like it's so far out of reach. You might be surprised. I have seen people get approved for a home with a 590 credit score. It can happen. Now you're going to be paying a little higher interest rate potentially, but there's also programs out there that can help. So do your research. But know your credit, understand your credit, and understand what you can afford. So that's your first step. I would say get your lender involved with that step because you might be surprised. They might say, hey, if you just fix one or two things here, we should be able to qualify you within 90 days, 6 months. I think go on that journey with your lender. If you have a good lender, they will educate you even if you're not ready today, but at least you know what steps you need to take. Then you can get pre-approved or qualified for your mortgage loan with your lender. If they decide, hey, you know what, you're already ready. The next step is we're going to put that application on, you're pre-qualified. They're going to give you a certain dollar amount with your income, your credit score, all your debts outstanding. They're going to say, here's what you are pre-approved for. So if they say you're pre-approved for $250,000, the next thing you're going to do is you're going to work with your realtor to find your dream home. And then you're going to make an offer. And unlike the market the last couple of years, in a dream world, that offer would get accepted right away. And you wouldn't be outbid and some investor wouldn't come in and swoop that up from underneath you. But let's just say it goes smooth. You make that offer, it gets accepted, and you have your down payment ready. Now you're in escrow, right? You're under contract. And then you get towards the end where you meet that title company and you bring your closing costs to the table. So closing costs, do your research on that too. And I will tell you, I'm not a realtor. I don't sell real estate, but you can negotiate now. There's some wiggle room because properties are sitting where you can look at your closing cost options. And I can answer some questions towards the end on that and give some advice. But again, I'm not a licensed real estate agent, but I can give some helpful tips and tricks that can help you with the lending process that might even help you qualify for more. And also look at your programs in the community. I know Pima has some housing programs where they'll do some down payment assistance. Your lenders probably have down payment assistance, but we'll get into some of that here in a second. So that would be the dream, right? We pull our credit report, we get pre-approved, we make an offer, we got our down payment, and now we're looking at bringing our check to the title company. Okay, down payments. I hear a lot of the 20%. I don't have 20% down. You don't need 20% down. Now, if you want to pay less in interest and less in PMI, private mortgage insurance, and I'll tell you the difference between that and homeowners, then yes, let's try to put as much down as we can. But I don't see too much of the 20% down these days, but we do see a lot of 3% down. There are some really amazing loan programs and types of loans you can get that require very little down. This is not a commercial for OneAZ, guys, but I will tell you in January this year, a program was available at the credit union where you could do 0% down, and I did that. So I think I actually got a check back at closing. So know your programs. Your lender might have something similar where you do 0 down, or they'll give you money towards your closing costs or your down payment. Just do your research. That was something that I chose to do because I wanted to save that cash for any repairs or having that savings once I got into the home. But you can go anywhere from 3 to 20% down, and maybe look at different programs where there's 0 down. I don't know how many lenders offer that, but know your options. So if you don't have a lot of savings, then you're going to want to look at different loan types and programs. So in this scenario, on a $350,000 home, if you did 3 to 20% down, you're looking at $12,250 to $70,000 down. So I don't know about you guys, but I don't have $70,000 in my bank account right now. But I'm not doing bad, but I don't have that. So I might lean more towards a 3% or 0% down so I can hang on to my savings. Okay, monthly mortgage payment examples. So on that scenario, $350,000 at a 6.5% rate, not our rate today. On a 30-year term, if you put 3% down, your monthly payment would be about $2,766. 10% down, you're looking at about $2,601. 20% down, you're looking at saving about $500 a month, but a lot of interest over time, monthly payment of $2,248. Now I'm going to pause because I did forget to mention something earlier on those, on the payment earlier. If you put 3% down, I want to talk about PMI for a second because this can be a little confusing. There's private mortgage insurance and there's homeowners insurance. Your homeowner's insurance protects the collateral, it protects the property. So if you have a fire or a natural disaster, anything happens, you're going to seek homeowner's insurance. You're going to get a policy. And then if it's in your escrows, your mortgage company is going to help pay that policy for you within your payment. Private mortgage insurance protects the lender. These are two different things. A reason why someone might want to put 20% down is because they don't want to pay the lender's private mortgage insurance. The less you put down, the more risk to the lender. So we're going to want to protect ourselves as lenders. So we're going to get insurance so that if you default on the loan, we're protected. We can recoup those costs. So the less you put down, the higher that private mortgage insurance is. And the bank's not going to pay that insurance. They're going to make you pay that insurance. So your private mortgage insurance is going to be high. It can be a couple $100 a month, which might, disqualify you from the loan. It might not qualify you for the loan. So if your private mortgage insurance is going to add an extra $300 to your payment, you may no longer qualify, or you might have to consolidate something else. That might be where a lender says, hey, we need you to close out this loan in order for you to qualify for the mortgage payment because your debt to income is off. But that PMI can increase your mortgage payment, and it's to protect the lender. And the reason is, you might say, well, why, if you can just take my house if I don't pay? By the time that we go into foreclosure and pay all of those legal fees and try to have to resell it at a reduced price, we could potentially end up actually losing money on that dwelling. So we like to just protect ourselves and add that PMI. But those are two different things. Private mortgage insurance is the lender's lending insurance, and then the homeowner's insurance is to protect your dwelling. Kind of like renter's insurance, car insurance. But the less you put down, the more PMI you're going to pay. Okay, and if you kind of want to have some fun or see where you're at today by plugging in your existing payments, your auto loans, your credit cards, any payments that you have outstanding, you can actually use one of our calculators. There's lots of calculators out there. You can just Google a home calculator, payment calculator, but for your reference, if you wanted to use ours, homeloans.oneazcu.com/calculators, that'll take you to a helpful tool to see what you might qualify for or what your payments might be. Pause in case anyone wants to write that. Okay. How to borrow wisely. All right, the do's of borrowing. raise your credit score, then borrow if we can, right? Sometimes we need to borrow and we have an emergency, but if we can, let's try to raise that score. A fixed rate is better than a variable rate. Again, depending on your scenario, but I would say today's market, you'd kind of want that peace of mind, but it's personal preference, but fixed rate is more secure. Larger down payments can improve your rates and lower or even eliminate your mortgage insurance. And shop around for those best rates. Pay off your debt early when you can, and review those truth in lending statements. Look at the fine print. Okay. Don'ts of borrowing. We saw those: predatory lending, payday loans, title loans, and don't carry a credit card balance. Now, if you, that one to me, I would choose different words because sometimes we have to carry that, right? If we had an emergency and we can pay for ourselves, well, I would have just paid for it, right? But just try to pay it down as soon as you can, and look at your utilization. Again, that 30% mark is where you can really increase your score. If you can get the amount of outstanding credit card debt you owe under 30% of the available limits that you have combined, your score will jump up. It can jump up 80 to 100 points by getting that under 30% utilization. So take a look at that. Obviously, if we didn't have to carry a credit card balance, we wouldn't, but there might be a scenario where you want to buy concert tickets instead of paying more towards your principal. Pay towards your principal. That would be my advice. Okay, we have some good resources here. We love our QR codes. You're going to see a few more along the way, but some guidance and different resources. There's a QR code here. And then we also have our YouTube, and I know this is also going to be recorded and posted. So if you need more financial tips and resources outside of our Money Matters, especially because we don't have our next one till spring, go ahead and check us out. And lastly, my favorite part is we have this amazing offer. You can actually scan this QR code. If you are a student or associate faculty of Pima Community College, we will give you $100 for starting your relationship with OneAZ Credit Union through this partnership. You can do that by visiting one of our branches or scanning that QR code. I know we've had a lot of students that have become amazing members. They reach out to me all the time, asking me lots of great questions. I love it. But this is a great offer. For students, you just need to use that debit card 5 times and we'll put $100 in your pocket. So feel free to scan the QR code. You might have seen this on campus. We've been out quite a few times this year. And lastly, this one, you do not have to become a member. This one is just a fun raffle we're doing. It drives you to our Pima landing page, but every presentation we like to pick a winner and do a drawing. So this again does not sign you up for an account. This is just a fun raffle that we're doing at OneAZ Credit Union. Scan that QR code so that you can enter to win. We were giving away a backpack and a gift card the last time, and this time we've increased the gift card amount to $75. So scan that QR code, enter to win, and the drawing ends November 17th. We will pick a winner. So I'll leave that up there for a couple seconds to get you guys' chances to win. And again, this one does not sign you up for anything. This is just to register to win for the gift card. For joining tonight's presentation and putting up with me talking so much. Okay. I will stop sharing now.
Okay, so we did have an activity planned, but we do want to just jump into the questions because we got some really great questions and we want to make sure that all the questions get answered. So we're going to skip our activity we had planned, but thank you, Simata, for creating it. But we do want to get all of the questions answered. So the first question we got was, are there credit cards that you pay off biannually instead of monthly, or are there only monthly payments credit cards?
Yes. So there's a couple of things I've actually been seeing out in the industry. Some of you may have this or have seen it yourselves, but you can actually build in installment payments in your credit card now too. You might get a teaser saying, hey, if you do this purchase, you can actually pay it off in 6 monthly payments. And now your minimum increase, but you're going to be paying off that credit card balance in 6 months. So you can work that. You also have credit cards that are tied to checking accounts and they force you to pay off the balance every cycle. So they'll just withdraw that balance from your checking account. It gives a little more security to the lender, but there are different types of payment styles on credit cards, but typically you're going to see the monthly payment due. I've never heard of anything biannually, but I do know that we do full balance owed every single month, or you can build it into installment payments now. That's something I saw a lot of this year.
Great, thank you. So it's kind of a statement and kind of a question. We had someone say that they have a terrible credit score, but they want to build it. They don't currently have a job, but they do receive money for attending school, like Pell Grant money. And they want to know how they can build their credit off of that. And they've never borrowed any loans. And they don't have a real bank account. Does that make a difference on trying to build credit?
You know, your checking account is not tied to your credit. The only time that you'll see a checking account really impact your credit is if you have a charge off. So the checking account itself won't actually help you establish credit, but you can look into secured loans, which we actually didn't cover today, which is a good add. Maybe I need to add that into my slide, but you can actually build credit through either a secured credit card or a secured loan. That means you're using your own money to establish a credit history. And you might think, why would I want to do that? It's because you're automatically approved. And you're actually helping the bank by telling your own story, saying, well, I can borrow from myself and pay myself back. And that actually gets reported to all 3 credit bureaus. So look into those shared secured loans or credit cards, because you may not need steady income as long as you're using your own funds. So, and yes, I know the last one we actually got questions if we offer those, and yes, we do. But you can also look at other lenders who do maybe secured credit cards. What I will say with the credit card versus the loan is if you are someone who's living paycheck to paycheck, and 63% of Americans are today, you may not be able to wait 2 to 3 weeks to get that card in the mail, and they only make a certain portion of what you put down available to you. So look at your loan options to help you build that credit. The other thing you can do is establish a checking account. The checking account itself is not actually going to help you establish credit, but now they have I think it's Experian, where you can actually report your own utilities and your own cell phone bills to help you start building credit. And what you would do is you would go into one of those credit bureaus, you would link your checking account, they would have access to that history, and any payment that's being auto debited or reported consistently every month would actually start reporting to your credit bureau. So your cell phone bill, your electric bill, those can help you start establishing credit through giving the credit bureaus access to your checking account, but the checking account itself would not actually help you establish.
Thank you. Okay, the next one is, does a paid off installment loan always remain as part of your credit mix?
Yes and no. Actually, it'll stay on there. It's typically about 7 years, and then it'll drop off. So 7 years from the time that you made your last payment.
And
you
is
do
that
want
with,
it if you have, I'm sorry, go ahead.
no, is that with like any credit item?
Typically, yes. Unless we're going into BK, and that's a whole nother subject, but yeah, if you're from the time that you make your last payment, typically it stays on your history for about 7 years, even if it's closed.
Okay, good to know. Okay, so the next one is actually about federal student loans. So I'm going to ask the question and then I'm going to answer the question.
Okay.
So it says, I'm wondering about FAFSA, federal subsidized loan. How does that work and when to pay back? So a subsidized loan is a federal student loan. So you don't have to, you do have to be approved, but it's not going to be based off of your credit. So you kind of apply and you say you want the funds, and then you can use those funds to help pay for school. When to pay them back. So students don't have to pay towards student loans while they're attending school, and they have a 6-month grace period after they leave school. So if they either withdraw from their classes or stop attending or finish school. So you have a grace period for 6 months before you have to start making those payments. Those payments are going to be based off of how much you've borrowed in your lifetime, what payment plan you're on. So there's a whole bunch of different options. So you'd have to work with your loan servicer to actually decide what payment plan is best for you, how much you can pay each month, things like that, how long you want to pay. So A regular payment plan or standard payment plan is 10 years, but if you've only borrowed a couple thousand, you don't want to wait that 10 years because then you're paying a lot in interest in the end. So you'd want to work with your servicer to actually figure out what payment options are best for you once you hit repayment after school. Hopefully I answered that question. Okay, if you have more questions on that, you can always email us at scholarships@pima.edu and we can help answer any more of those FAFSA questions. So the next question is, does OneAZ have a student credit card?
We do not have a student credit card, but you can definitely reach out to one of our bankers or even myself, and I'll talk you through. If it's your first card, you might still have options. We don't call it a student credit card. We don't have a product specific for that, but we definitely have options to help you if you're just getting started.
Awesome. What types of student loans should be avoided? I can answer that one too. I would say private student loans. Private student loans usually have really high interest rates or higher interest rates than the federal student loans. So if you could get qualified or you qualify for federal student loans, I definitely go that way instead of private student loans. Vanessa, I don't know if you have anything to add on that.
No, I agree.
Okay.
You're
Perfect.
the expert.
Perfect. The next question is there a certain age you need to be to apply for a credit card?
Some lenders will ask that you're 21, but you can 18 is a good start. My daughter, when she was a day into 18, got her first secured and now has her credit card. So I would say it's never too early to start establishing, but there are lenders that will let you borrow at 18.
Perfect. I did that with my kids too. I added them to my credit cards once they turned 18, and then like 6 to 9 months later, I had them apply for their own line of credit to help build their credit.
Yes, that's a good point. That's authorized user, folks. For those who don't know what that is, you can add somebody as an authorized user. They don't have to apply for the credit with you, but you can add them to your established credit card. So it shows they have that length of time and it instantly starts helping them build credit.
Okay, so the next one is more of a comment also, that they have a fixed VA loan, but the mortgage changes due to property taxes. I don't know if you want to address why the property tax would change the mortgage, or if it's just the monthly payment that goes towards the property tax.
Yes, so even on a 30-year fixed, the escrow account. So if the lender is notified that the property tax went up, taxes are part of that escrow. So the payment, the terms, the interest, that's not going to change on you on a fixed loan. But if your taxes, your property taxes have gone up, your homeowner's insurance policy has gone up, your payment will also increase, but the lender should be notifying you that those changes are being made.
All right. What are your thoughts about credit card balance transfers during promotional periods?
Do it. I'm just kidding. No, do it if it's OneAZ. No, I'm just kidding. No, I'm just kidding. No, honestly, on that one, again, read the fine print, because if you actually do a balance transfer, if there's a fine print in there that says we're going to backdate that interest, be very, very careful, because if there's excessive fees with that, you're going to want to look to see if it's really worth the cost. So let's just say you did a balance transfer and they said your promo rate's going to be 1.99% for the first 12 months. But if you don't pay it off at that 12 months, we're going to backdate all that interest. That's going to be a nice surprise when you open up that statement on the 13th month. Now, not most lenders won't do that if it's an actual financial institution. Typically, when we see something like that, a promo or a teaser, it's on one of those store accounts. But definitely read the fine print. At the end of the 6 months or 12 months, is your rate just going to adjust to the normal rate? Or are they going to backdate interest on you? It's a good idea if you know you're also going to pay it off within that time frame. So let's say you have a plan to pay that card off in 6 months. So getting that promo rate is going to help you pay that off faster. Now, if you have a balance of $10,000 that you've been carrying for 2 years, and you do a balance transfer and it's good for 6 months, but you know you're not going to pay that off in the 6 months and your rate goes up, then it might not have been worth doing that balance transfer. The other thing you have to look at are fees. So most lenders, not OneAZ, will charge you a balance transfer fee. So it could be 3, 5, 6%. So yes, that 0% offer looks amazing. And it looks better than that 1.99% balance transfer option. But look to see how much it's going to charge you to transfer that balance. It could be hundreds of dollars on your next statement just for doing the balance transfer fee alone. So do your research. If it makes sense for you and you know you're planning to pay it off, some people like to just continuously transfer those balances and get those low rates, and that works for them. But then you also have to look at your inquiries. Look at how many inquiries you're doing, how many new accounts, how many cards you're opening in a short period of time. It actually can be beneficial. We do them a lot, but really look at the balance transfer fee. All jokes aside, you can be paying a hefty fee if you didn't read the fine print. And also making sure that you get it paid off in time if there is a term built in there that says that they're going to backdate that interest on you. Most lenders don't have that backdated interest, but I have seen it before. But they can be good options if you have a plan to pay down your debt.
Great information. I am learning so much tonight. Thank you, Vanessa. We have a couple more questions. Do personal loans have fees?
I have not seen like any annual fee or anything like that on a personal loan. What I will say is they're going to have higher interest rates though, because they're unsecured, but I haven't seen an annual fee on a personal loan. Now, some of those predatory lenders might have an early payoff fee. So they'll, if you paid off before you've agreed with them, then they might charge you a significant early payoff fee, but most legitimate loans, personal loans that you might get from your financial institution are not going to have any annual fees or any prepayment penalties.
Good. Okay. Is there anything different you can do if you don't have anyone who can co-sign on your student loans? I can answer that one and then I'll have you jump in for co-signing on other loans.
Okay.
So for federal student loans, you don't need a co-signer. There are either the subsidized or unsubsidized federal student loans, and those you can't even have a co-signer on. There is a Parent Plus loan, which is a parent taking a federal student loan for their child to go to school, but it's not a co-sign situation. The parent themselves are 100% responsible for paying back that student loan that they took for their child to go to school. So it's not like a co-signing situation. For private student loans, there probably are co-sign options, but we want you to stay away from those loans anyway. So if you are looking into private student loans and you need a co-signer, and your application tells you need a co-signer, there's probably not anything you can do to get around needing that co-signer to be approved for that student loan. Vanessa, I don't know if you want to add co-signing on other types of loans.
Yeah, I think it would be helpful. Some more lingo for you guys. You have joint borrowers and you have co-signers. Joint borrower will help you qualify within your same household. So let's say your income isn't there, but you live with somebody and we can use their income to help you qualify. That's going to be a joint borrower. When you get into a co-signer situation, if they're outside of your primary home, they don't live with you, we're really only going to use that person's credit score to help you qualify for maybe a better rate, which could help you get a lower payment in order to help you qualify. But using their income, you're still going to have to qualify on your own if they do not live in the same household as you. So there is a joint borrower, and then there's also your co-signer. If you're asked to be any of these things, be very careful because somebody may not pay on that loan. And whether you're driving that beautiful car, you just help somebody out, you're co-signing, you're signing up for those terms and conditions of that loan, whether you plan to drive that vehicle or not. Your cousin calls you up and your heartstrings. I think this actually was a question on one of Samara's last awesome engagement activities. We talked about a want or a need helping, I think, a sister out or something like that. But yeah, really think about if that's a need that you need to do. I know we really want to help our loved ones, but really be careful because you're signing up for, it could be a 7-year auto loan. that you're signing your name on, and whether they've agreed and said, I'll pay the payment if you just do this for me, you're actually taking on that responsibility. So if they lose their job, they can't pay that payment, you're financially responsible for that once you're a joint owner or a co-signer.
Yes, thank you. Okay, so we have one more question, I think, and then we're going to go into our closing. So the FAFSA subsidized loan can only be used towards tuition. So any type of federal funding can be used towards educational expenses. So that can include tuition, fees, books, supplies, transportation, housing, anything that a student would need as support to help them continue in school. So you can use, if your loan goes above your cost of tuition and fees, and say you get $1,000 back, that can go towards childcare, that can go towards buying a computer, that could go towards books. It can go towards anything that's going to help you continue in school. So not necessarily just tuition and fees, but you can't get a federal student loan if you're not attending school. So it has to go through the school. It has to be paid directly to the school. And then if there's more than what the school needs, then they will send that amount to the student to help with those other living expenses that are included in that cost of attendance for them to be attending school. Let's see. I think we are good. Do we have any other questions? Are we good to transition, Simara? Okay. Perfect. Thank you, Vanessa, for all the information and answering all of the questions we received tonight.
Oh, thank you. Good questions. And I hope everybody has a safe Veterans Day weekend too.
Yes, thank you. Thank you so much, Vanessa and Juanita. Well, this concludes our time for questions and answers. And thank you, Vanessa, for the great presentation and the time that you took to educate us on this important topic. Well, if you wish to continue learning about borrowing, because I know I do, please feel free to access our virtual handout flyer that offers great resources, and the slides that we use today will also be available through this link. We are actually sharing those links through the chat. Thank you, Anna. Oh, I'm so sorry. 1 second. Okay. So I think right now we can move on to who are our winners for those who followed us on our social media accounts for first year experience and for the Office of Financial Aid and Scholarships. Those who did follow us on social media entered in a drawing, and the following people are our winners. Congratulations to Leaf Lynn and Ash Huffman. Our winners will get a prize bundle from PCC First Year Experience and the Office of Financial Aid and Scholarships. Please view the screen to see the prize bundle. We will send your prize package to the mailing address listed in your Pima profile. Please allow us a few weeks to package and deliver your prize by mail. If you do not receive your prize by this time next month, please follow up with us. Again, thank you for following us on social media, and congratulations. Now there is another prize opportunity. So if you're feeling lucky, all you have to do is visit the partnership webpage between Pima Community College and OneAZ Credit Union. You can either scan the QR code on the screen or click on the link that was just shared on the chat. Sweepstakes begin Thursday, November 9th and will end Tuesday, November 14th. The winner will be selected on Tuesday, November 17th by random drawing. The prize will need to be picked up at one of the OneAZ Credit Union branches. And again, that prize is a $75 Visa gift card. So Christmas is coming. That's definitely going to be super helpful. So all you have to do is visit Pima's and OneAZ partnership page. Well, thank you everyone for attending our last Money Matters session for this fall semester. We hope that you found great value in the information shared today. And a friendly reminder that we will have 2 sessions for our upcoming spring semester. We will post those dates on our Pima Engage and our Pima calendar. So please keep an eye out for those upcoming events. We're also going to be sharing a link, to those calendars. Also, if there are topics that you would like us to present in the future, let us know by taking our feedback survey. By completing the survey, you will earn a certificate of completion. The certificate will be emailed to you in the next few weeks. Remember, if you attend the 2 fall Money Matter sessions and completed the feedback surveys, you will be entered in a drawing for a $300 tuition award. The tuition award can be applied for either the spring or summer 2024 semester. Well, this concludes our presentation. A huge thank you to our partner from OneAZ Credit Union, our partners from the Office of Financial Aid and Scholarships, and first-year experience at Pima Community College. Thank you for making this event possible, and a big thank you to you, our community, for attending. If you would like to follow up with us, our information is being shared on the screen. Please reach out if you have any questions or if you need help with anything. Take care, and I guess we'll see you next year. Thank you.